let's talk about why you want to purchase life insurance for your kids. First off, we're going to be looking at whole life insurance, and we're going to call it cash flow whole life, which we'll get into in just a second. The biggest thing to think about here is the earlier you start, the cheaper this is. Take it from someone, I'm 44. I've had life insurance my entire life, but policies has come and gone. And I found myself now with a term life policy that has the payout benefits that I want, but I also know that it was a 20 life term that I bought 10 years ago. So when I turn 54, I'm going to have a problem with my life insurance. I've started working on my own whole life policies, and I found that the costs relative to what they could have been had I done this earlier are astronomically higher, primarily because I don't have the value of time from a compound interest perspective. Now, in the video on how to, I'm going to give you my point of contact for who I work with on this, that you can work with them directly. You can reach out, set up a meeting, and they'll walk you through the process, and it'll make life a lot easier on you. To prepare you for that, I wanted to go through what life insurance, whole life insurance looks like, what it costs, and talk more about why we want to do that now. So let me share my screen. Let's take a look at this one first. All right. So the funny thing is I've talked to multiple brokers, and they all, in the end, ended up back at the same company, which is Mass Mutual. So that actually makes me feel good that this is the right company to get the policy through. You're typically going to go through a broker. Don't use the information you see here, because I've talked to multiple brokers. I've gotten quotes from multiple brokers. More importantly, I wanted to find a broker that actually listened to me, because I have bought policies for my kids that didn't turn out to be what I wanted. And it's either somewhere between miscommunication or them just being dipshits, pardon my language. So use the contact that I'm going to give you in the next video in order to get this process started when you're ready. But let's go through this document. The first thing that you're going to see over here is the net death benefit. Now, initially, I wanted to just get something in place. I wanted to get them started while also setting up a policy that allows them to increase the death benefit later. As they get later in life, their family dynamics change, their wealth profiles change. You want to be able to adjust these things. And if you don't ask for that, you don't get the rider that allows you to do that. We'll talk more about that in the next video. The current outlay, so the first year, so this is a new policy that I set up in 2022, was $1,050. Okay, you'll see that over time this number goes down. So the first 5 years it's $1,050, then 1 year it's $632, and then basically for the rest of their lives pay $339 a year to keep this policy going. Now let's look at some of the numbers here so that we can hit some of the transitional points. The first thing that I like to look at is the net annual cash value increase. All right. So here I give them $1,050. The policy's cash value only increases by $660. The rest of that is premium. Now let's get down here. $632, $627, $339, $382. So this in year 7 is the first time that when I put in money, my policy actually grows by more than I put in. And you start to see that the net death benefit starts to increase. This is a transition point. This is where being early, adding more years into the equation, gives you the opportunity to take advantage of compound interest. What's nice about these policies is they have a guaranteed rate of return. So most of these policies are around 4%. While there are other dynamics in the markets that can outperform that, there are other benefits to this type of policy that are advantageous. So let's look a little bit deeper. Now, cumulative net outlay versus net cash value. Now we move down this chart and we want to see, okay, in year 15, I've put 8,900 in and I've got 8,800 in cash value. So I have $107,000. By year 16, my outlay, the amount of money that I've given them, is less than the cash value of what I can take out. So that means if you start this when your kids are just born to about 3 years old, by the time they turn 18, this is now a positive cash value asset with a net death benefit that is significantly greater than the amount of money that you put in. Every year going forward, the spread of value, meaning the amount of money that you have gained by having this policy or earned, is significantly outweighing the amount of money you put in. Now, that's a pretty good deal. And by starting them early, you've put in less money each year. For example, I'm going to show you in the next proposal what $1 million policy looks like, $1 million by the age of 65. And you're going to see that although the outlays on an annual basis are more, me trying to get that same policy today would cost 20 times more, to the tune of about $20,000 a year with a $55,000 outlay the first year. Now, those are some pretty big numbers to get the right policy in place because I waited until I was a little bit later in life. Now, I can balance that out with term and bring the cost down, but this video is about your kids. So let's scroll down a little bit. Now let's start looking at a couple other different metrics here. At the age of 25, they will have $16,000 in cash value here. Why is this important? They can borrow against this policy for 0% interest and without diminishing the death benefit from a paper value perspective. Now, what the hell does that mean? If they were to borrow this $16,000 to say, I don't know, put a down payment on a rental property, and then they were to pass away, unfortunately, and their spouse or their children would need to collect the death benefit, they would get the death benefit minus what they borrowed. So they would still always have that $100,000 core plus a little bit of extra in there. This is the best way to get interest-free loans later in life. Now let's watch how compound interest starts to accelerate to the point that by the time they're 65, they have $147,000 in cash value that they can borrow against interest-free. They've also got a death benefit of about $260,000, which, depending on their overall wealth profile, is a decent chunk of change. Now, if you look at the average life expectancy in the United States today versus we hope that it changes dramatically over time, if they live to be 85, they now have got $400,000 in death benefits. And if they live to be 100, they've got almost $600,000 in death benefits. And look at the amount of money that they can borrow. The net cash value is actually greater than the death benefit. So it might even be advantageous to borrow all of the money out of the policy at that time. Now, thinking about your kids living to 100, and who wouldn't want that to happen? But what you're seeing is the power of compound interest. Also, if they live to be 96, they don't have to pay premiums anymore. How nice. The earlier you start this, the greater it compounds. Now, let's look at one more. And I'm going to apologize. This was the why video, and it turned out to be the how-to. So below this video, you're going to see the point of contact that I want you to use in order to set up your life insurance policy for your kids. So let's jump over here. All right. This time I wanted to do a $500,000 initial policy. And I just wanted to see what the numbers looked like. First year outlay, $5,600. Net cash value, $4,133. So I look at this and I want to understand my costs. So to get a $525,000 life insurance policy, my cost in the first year is actually about $1,500. The rest of it is going into net cash value. Then that number is going to drop to $1,200 a year. But my net cash value, like, there's a lot of premium being paid up front. So let's go down the chart and let's look at this again and figure out where we're going to see a swap. So net cash value by year 6, again, the amount of money that I'm putting in is less than the amount of money that my annual cash value increase. So that's that first swapping point. Now, it's usually around year 15, 23, 25. It actually happens a little bit earlier here, 20, 19, 19. So here, when they're 12 years old, I put out $19,500 and their portfolios were, or their policy has a cash value of 19,000. So basically around year 13, it swaps where my cash value is greater than the amount of money I put in. Now let's scroll down. When they get into their 30s, the death benefit is going to start growing. But notice this, by 35, right? Now they've got $100,000. Even at 25 years old, there's $50,000 in there. That can be borrowed against for the down payment on a house. It can be borrowed against to start a business. It can be borrowed against to buy a rental property. There's so much that they can do with this net cash value money. It can become their emergency account so they don't have to keep cash on hand. How nice would that be? Yes, the annual premiums are more expensive. Let's look. I'm getting 5 times the coverage, and I'm going from 300, and I'm paying about 4 times the annual premium. So I am getting more value for my money. Now, a $1,200 commitment, $100 a month is a little bit greater than the $300 a year that you're going to pay on the other policy. Let's look at, I mean, it goes down over time, but it never, like, again, it's not until you're 100, which by then you have $2.2 million. Let's look at 65, $500,000. This becomes a big chunk of their retirement portfolio now. Depending on their Roth IRA, depending on their brokerage accounts, their bonds, here's another $500,000 honeypot that you paid $84,000 for. Who wouldn't want to do that for their kids? Now, for you, your balancing act might be somewhere in between these two. It could be greater than this, depending on your personal position. We do like to say that you want to at least get a $100,000 policy because of its advantages over time for its net cash value and its death benefit opportunity so that you can borrow against, or you can continue to let it compound. The key point to all of this, just like all of the other accounts, is the earlier you start, the less expensive it is, and the more value that you can grow in this. So contact my guy below, start this process. We're here to answer any questions. He has our roadmap. We let the professional do this. He knows about the riders that we like to see. We know about the ability to increase the net death benefit over time. It's all worked in there so that you don't have to intrinsically know how to do those things and contact your own broker, which, by the way, you can, but we recommend going through our guy. At the very least, hope that your broker makes it back to Mass Mutual. Now, look, why Mass Mutual? There are some rules that come from a book by Garrett Gunderson called What Would the Rockefellers Do? And he gives a pretty good outline of when you're doing these types of policies, what are the rules for the companies that you want to do them with? You want them to have assets under management of at least $1 billion. You want them to have been around for at least 50 years. Mass Mutual is well over 100. You want them to have a return rate that has been tracked for decades. They do. They have all of the different things that you need in order to feel comfortable with the company to the extent at which that you can. And there's a lot of other metrics and dynamics in there that you can ask your broker about. All right. Contact our guy below. Tell him you're from our program. He'll know exactly what you need. He'll work with you to figure out the right numbers. Start with a minimum of 100,000. If you can afford it, go up to $500,000 on net death benefit. You've seen the 2 tables and what they're going to look like. And let's continue to build wealth for our children. Thank you.